Welcome to another episode of the Capital Playbook. Thank you so much for joining us. We're so excited to bring some content today that I think you're going to be very interested in. Today, we're going to talk about USDA lending. Now, some may not be familiar with the fact that there is a USDA government-backed program for lending on commercial real estate deals. But we're going to talk about that, what properties qualify, what people qualify, how to use this as part of your capital strategy when you're engaged in commercial real estate projects. And today joining us is a true professional, our resident expert, Jana Rubel with Liquidity Financial. Hey, Jana.
Hey, Charles.
Hey, thanks for being with us.
No problem.
Yeah. So Jana was with us on our previous podcast show, the CRE Advantage. She was able to provide a lot of good information on USDA lending. We're going to go over that, some more of that. But there have been some updates to the program that I'm sure you're going to be interested in. But before we get into our program today, there are a couple of housekeeping things that we want to take care of. If you are watching this on YouTube, do us a favor, subscribe to our channel. When you subscribe to the channel, it does several things. One, it allows us to attract guests like Jana, who are subject matter experts that we can bring onto our program to give you information that would be hard for you to get. So make sure you subscribe and also like our episode. And if you're on our other venues, such as Spotify or Apple, please be sure and do the same thing. But with that being said, let's talk to Ms. Rubel and find out a little bit about her background and a little bit about this USDA financing program.
Thanks, Charles.
Yeah. So, Jana, now you and I have known each other for a number of years. So I know a lot about you from the business side. Little personal things I may know about you. But tell the audience how you got into banking.
Yes, so I started this career in the SBA world about 26 years ago, and it just progressed from being an underwriter and approving loans to being a business development officer looking for loans. And so my background has been with a lot of different banks, which happens in the banking industry, unfortunately. Mm-hmm. I've been at my current bank, Liquidity Financial, for the last 4 years. But the staff at Liquidity Financial as a group, we've pretty much been together for about 10 years. We all came together from other banks where we worked together, which makes for a really great team. Wow,
that's great. So I know since I've known you, you have probably been with 3 or 4 banks,
Yeah,
right?
Right.
But it's interesting that as you move from bank to bank, it seems like the programs, the capital availability gets better and better. Would you say that's been the case with this particular move?
Yeah, I mean, it comes down to the credit box mm-hmm. and what each bank's willing to do. As you know, more than anybody else, as you're trying to help your clients find loans, each bank is different, which is the reason that it's best to use somebody like you mm-hmm. to help them, because if not, there's just a million banks out there and you won't know who's going to do which loan. Right. So my bank, our credit box is pretty broad, mm-hmm. Which makes it a lot more advantageous for you to call me mm-hmm. and for me to help your customer. Okay, well, very good. So, and that's something we talk about all the time is in the capital markets, there are capital specialists, capital programs, capital groups that are there to solve a specific problem. Mm-hmm. And your group is no different. You guys you do a lot of different types of financing, but your specialty is USDA financing. Is that correct? That's correct, yes. Both SBA and USDA, mm-hmm. But there's very few lenders out there that have the capabilities of doing USDA. Right. And we literally hired somebody as a credit underwriter from the USDA. So it gives us a little bit of a heads up when we're trying to get loans approved, because the packages he puts together and sends into the USDA are much stronger than other lenders will do. Okay, good. So tell me, why would someone who is trying to transact a commercial real estate deal, what would be the reason they might want to consider USDA financing? Yes. So obviously, the number one rule with USDA is that it has to be in an eligible area, which, as a rural area, that's less than 50,000 people. Sometimes, if you're close to a metroplex, then it doesn't count, even if your town's small, because you are put in together with the larger towns around you. But if there's a website that the USDA has, it's pretty user friendly to look up your city, find out if you qualify for USDA loan. And then the loan to value is typically around 80%, which can help a lot of customers who maybe can only get 60 or 70% in other loan programs.
Okay, yeah. So we talked about the USDA eligible areas. Okay, so if I am let's say that I want to purchase a hotel in a USDA eligible area, I have some options. I can do private lending. I can do SBA, qualify for SBA. I can do conventional, regular bank financing. And if it's in one of these rural eligible areas, I also have the option of doing USDA. Now, so there are 4 or 5 different options that I have. What would be the advantage for me as a buyer to choose a USDA option?
Well, sometimes the advantage is that maybe you can't get the other funding. So, so obviously,
so go to USDA when nobody else will fund you.
It's sometimes there's criteria that are involved that make it kind of the place to go. One of them is if you are refinancing debt. For instance, with an SBA loan, if you're refinancing a debt, then the debt needs to be around for 2 years. But for a USDA loan, that debt can be refinanced after 1 year.
Oh, okay.
So I literally have a deal right outside of Austin right now, which is a hotel, and I think that it would actually make a little bit better SBA loan, but they don't qualify. So, and another reason would be that a lot of these deals are going to be SBA type deals. So those type of small businesses. You can do larger businesses with USDA, but most of them are going to be the smaller businesses. And in that case, then USDA works if they've used up their SBA eligibility.
Okay. Makes sense. Now, are there any advantages with USDA loans with regards to the leverage?
So there is a ability, if you have extra collateral, to get down to about 10 to 13% on your loan to value. But that's if you had let's say you had one hotel and you're about to buy your second one, and you're willing to put the second hotel under the same corporate name. Okay. And if you were, then you could use the equity in your existing hotel, because you have to, again, be fully collateralized, and they discount a hotel by 80%. So that you have to make up that difference, that 20% difference. Okay. But if you have the collateral from your other hotel, then you can make up that difference and get down to that 10% tangible. Well, it's not tangible anymore. That's one of the changes. It's actually just balance sheet equity.
That's exactly what I was going to say. So now they look at balance sheet equity. So in other words, a lot of properties are in single purpose entities. So you may have one property that has 60% of its value in debt. Right. Okay. And then, but you're wanting to buy another property, and you only want to put 10% down. Correct. Well, that 60% or that 40% equity in this first hotel you already own, let's say it's worth $4 million, and you need $2 million to get you to the 90% equity on the hotel that you're buying. So what you're saying is you can take both of those properties, put them in the same legal entity, and now, as opposed to having the property as the only collateral under consideration, you can use your balance sheet, all of the equity in your balance sheet, to now leverage up to that 90%.
Correct. So they're still going to want that 10% down in actual cash, but then the other 10% that you need to be fully collateralized, you can include that. That's really amazing, because one of the things that hoteliers they're always struggling for is to get to that maximum leverage. And they like the maximum leverage because if they're buying it right, or if they're a very good operator and they can generate cash flow and good at generating returns or performing, then they can afford that debt, right? Now, when you're underwriting it that way, when they're leveraging the balance sheet, I'm sure you're doing some type of
global analysis on that entity that owns both assets, right?
Right.
Okay, and what is the minimum debt coverage ratio would be for if you had two assets under one entity?
Yeah, we're typically, as our bank is looking for 1.2%
Okay.
cash flow coverage.
And that's on that
That's the global.
internal global or sponsor global?
I mean, we would like it on the property they're buying.
Okay.
And then at least that on the global from that, whatever, any other businesses
All their
they
entities
own,
and then other
what
income.
they need personally.
Okay, perfect.
Yeah.
Well, that makes a lot of sense. Now let's back up a little bit because we're from the industry, so we're going to throw terms around like
Right.
they mean nothing to us. But some people are not familiar with the purpose of a USDA loan. Obviously, this is a government-supported program. It was created, it was designed to solve a particular problem for a particular purpose, right?
Right.
So what is that? Why did the government put another loan guarantee program? Because that's what SBA is. Mm-hmm. Why did they put another loan guarantee program out here for business owners to take advantage of? What's the advantage of the USDA?
Well, obviously, it's the rural areas that were not getting the lending that they needed. When you have a large national bank and a lot of banks, they really concentrate on metropolitan areas. So this program was put in place for this. The one that I do is called the Business and Industry Loans. Mm-hmm. So they go up to 25 million. Mm-hmm. There's other areas. A lot of times people will say, "Oh, USDA." Then can you do other types of programs? Mm-hmm. With my bank, I just do this BNI. Mm-hmm. But there are other ones that are. One of them's called like the REAP, which is for renewable energy, and it also goes up to 25 million. There's some community funds that are like if you had a big hospital in a rural area, and that's for the community. So there are some other programs that my bank doesn't participate in that are still covered under the USDA.
Oh, okay. That's interesting. I didn't know that about the hospitals. Let me ask you this. This is a little off topic, but since you brought it up, I just have to ask. In those rural areas where you're doing the specialized assets like hospitals, does USDA also work with new market tax credits?
Yeah, I think they would.
Oh, wow.
Yeah.
Okay, and we'll have to do a show on new market tax credits. If you haven't heard about new market tax credits and you're interested in free money, I don't know if you're interested in free money or not. We actually are working on a project now that we worked on a couple years ago during the construction process. Client built a $12 million hotel. He got a loan of $4.5 million. And he got $6 million of new market tax credit free money. So if you think we should do a show on new market tax credits, I want to see 500 likes on this particular podcast. And I'll show you how to get or what the process is for getting that free money for new market tax credits. Now, only if we get 500. Now, back to our program.
You're so funny.
So the USDA really is an advantage to those folks that are in those rural communities, where it would be very difficult. It's difficult to get lending on certain assets anywhere, anyway. No matter if you're in a metropolitan area or if you're in a rural community, but certainly if you're in the rural community, right?
Right.
Now, what type of businesses qualify for USDA loans?
And that's where, again, it's going to be your typical small businesses, so your hotels and your gas stations and loop centers and all those kind of car washes, all those type that you find in a smaller town. And then on top of that, you can have the investment type product, which would be like your Family Dollar store.
Okay.
You can have.
I did not know that.
Yeah, and you can even have like a retail center.
Really?
Those do also qualify, which is another reason that those do not qualify for SBA, but they do for USDA. Unfortunately, there was the RV parks that used to qualify, but that was taken out of the rules which is...
You mean I can't finance a trailer park anymore?
I know, it's like crazy. Well, you could never finance a
Well,
trailer park,
but an RV park. Okay, yeah.
And which you still can with the SBA. But it's funny how the rules change every year, which is why you have to get updated on what's going on between the USDA or SBA, and keep up to par with that.
Okay, well, very good. It is interesting that most people, when they're in these small towns, and they're looking at some of these assets that are traditionally hard to finance anywhere. For instance, a gas station or a convenience store with a gas station, or a dry cleaners. And these are interesting. Banks don't necessarily like them because of environmental issues, right? Yeah. But how do you guys with USDA get around those perceived environmental issues that are associated with some of these type projects?
I mean, I do a lot of gas stations. I would say that in the last year that the majority of loans I did were gas stations. We just get an environmental phase 1, as long as that's clean. The good thing with the USDA is you don't have to have a jobber that's approved. If you've done SBA, there's rules and regulations where a gasoline supplier needs to be on an approved list, but you don't have that with the USDA.
Okay.
I just closed a couple gas stations, one in Texas, one in Oklahoma, under the program, which is another thought that I forgot to bring up, is the fact that with the USDA, it works a little different than SBA. For everybody that's familiar with SBA, it is a state kind of run program. So each state has their own USDA office. And as a lender, we package up the loan package and we send it to that state for approval. And when you're dealing with Texas, different states, some are easier than harder. Texas has had kind of a bad rap over the last 20 years.
I wonder why.
Yeah, I know. I think because there's so much business here, maybe they decide to be a little tougher on loans. But they've actually gotten much better.
Okay.
Again, another thing that changed over the last couple of years is the USDA has tried to streamline their process a little bit more. And the result is that Texas is maybe getting a little bit more on board with, they'll still ask more questions than other states, but they're approving them quicker than before.
Okay, that's wonderful. Might be something to look at. What is the process typically from application to funding normally, just a general, what is that process in terms of time? What does it usually take?
So once you call me and you have a client, let's say, and I'll give you a term sheet within 24 hours, and they accept my term sheet and we collect all the documents, and I order the appraisal up front and environmental, so that we know that once my bank has approved it, which will typically be about 7 to 10 business days.
Okay.
Once we've approved it, we got the appraisal in and the environmental, then it goes to the USDA. If you're dealing with the state like Oklahoma, like I just dealt with, it was like 2 weeks, and they told us it was approved, and then you get an authorization from Washington D.C., and that typically can take an extra week or 2 weeks. So that's about a month for that. If it's in Texas, then you'll get approval in a month.
Sometime next year.
No. It actually the last one I did was just a month. So
really?
Yeah, it was a smaller loan, so I think that made it move a little quicker. If it had been a larger loan, I think they would have spent more time on it. But I think you could look at, once you do that package to the USDA, you should have that USDA approval within 30 to 60 days, which is a lot shorter than they used to be.
Yeah, absolutely. Now, so it is interesting, some of the processes with USD financing prior to submitting to the USDA. The client is kind of on the hook with some out-of-pocket expenses prior to knowing if their project is going to be approved. Tell us kind of how that works, and what should a borrower who's considering USDA financing, what should they consider, in terms of a expense factor when applying for this loan?
Well, typically what I'm going to do is ask for like $5,000 to $7,000 up front, again, so I can order the appraisal environmental, which obviously the customer can use for any bank if he went somewhere else. The good thing with the USDA is I've never had a deal go to the USDA and not get approved. So
that's a pretty good track record.
It is. I mean, part of it is that I do have that USDA underwriter. He knows everything about the process and the rules and regulations. Once he says it's a good and to go, then the
You feel
package
pretty
goes.
good.
Yeah, the package
Yeah.
goes in smoothly. They might change something here or there a little bit, but I just have never had one turned down.
Okay, well that's pretty good. That's the advantage for working with Liquidity Financial. So look her up. She, it's a pretty good track record if she's never had one turned down. And so that really makes sense. So one thing I do want to, I feel like I'm going back and forth because there are certain things that you mentioned that our audience probably could use some clarification on. Now, the USDA does not actually fund the loan.
Correct.
Okay, so they're like the Small Business Administration who provides insurance. Okay, we call it loan default insurance. Correct.
Correct.
To the bank.
Right.
Okay, so now most people don't like government insurance programs, but businesses do, right?
Right. That's what encourages us to make a loan that, as a bank, we might otherwise not make.
Right. So the way that works is when it's the same with the SBA. If you are applying for a SBA loan, the SBA is not making that loan.
Correct.
The bank is making the loan, and they're getting an insurance policy from the SBA. And just like with any insurance policy, there is a premium. And now the bank doesn't pay that premium, do they?
No.
They pass it on to the borrower. The borrower pays the premium, and therefore that loan or a portion of that loan is insured. So the USDA is similar. You're going to package the deal. You would say with USDA support or insurance, my bank, Liquidity Financial, will fund this transaction, right?
Correct.
Okay. Now you submit it to Liquidity, and they underwrite it. They underwrite the insurability of the loan, basically. So they're same as, I guess, bank underwriting. They're going to see if there's enough cash flow to where there's at a high degree of certainty they're going to get the money back, right? Correct. And they don't have to pay the bank for this defaulted loan. Now, does the USDA collect a premium?
They do.
Okay. So, now, how does that work?
And that's another thing that's kind of changed over the last couple of years. The guarantee on a USDA loan is now 80%, no matter what loan amount you do, even up to $25 million. My bank only goes up to $10 million, but no matter which loan size you got, you get the 80% guarantee. In the past, it was literally like a 70% or 60% as you got to the larger loan amounts. So the 80% is a much larger guarantee to the bank that if there is a default, that we'll get that 80% back. And the guarantee fee, which is what the customer pays, is 3% of that 80% of the loan amount.
Now, can you finance that into the deal?
You can to a certain degree. Obviously, you're looking at the equity down
right.
and the collateral. So
okay, but you can as long as you don't go above the required equity threshold.
Correct.
Then you can finance that into.
It's part of the total project.
Okay. Wow, that makes it a really nice program. I know when we look at USDA loans on paper, they are very attractive, and it used to be that. You could finance multifamily projects in rural communities with USDA, but I was just scratching enough nickels together to be able to put one together, and then they changed the program, so I couldn't do it anymore. You think they'll ever bring that back?
I haven't heard that they will. So.
Boy, wouldn't that be something if they did?
I think there's enough lenders out there maybe doing apartments right now, but you would have to
not
tell
in
me.
Rural areas though.
Really?
No, not really. I mean, you got people like me that's going to charge 12-14%. But no, they're not a lot. But I think we're starting to find more capital partners who will be willing to lend in tertiary markets. What's really interesting is. Again, I feel like I'm getting off topic again, but we have identified several Canadian lending sources. Some are debt funds, some are pension funds that are very active in tertiary markets with all types of asset classes.
Oh.
And they're lending at high leverage, which is very interesting. So there is a good market there. There's high demand for capital in those areas because those areas are growing too. And they didn't really expand their inventories during the financial crisis. in terms of housing. So there's quite a bit of demand. So there's opportunity there. So now back on topic with USDA financing. You mentioned one of the changes about the guarantee going up to 80%. Were there any other changes that recently happened in the program?
I mean, the only other one was that tangible.
Oh,
net
the
worth.
tangible, yeah.
Yeah.
And that's interesting that now you can leverage your balance sheet equity.
Mm-hmm.
Okay, so now you're using.
So if you have goodwill that's listed on there and you're amortizing that out, then if that's part of your assets, you get to count that.
That's interesting.
Yeah. Because they make a difference. So.
That's a big deal because goodwill is one of those more artsy type deals and not quite a science. Some people say you can kind of make it up.
Right. Well, you got to make it up when you buy it, right? So it's got to show up from original. It can't be something you add later on.
Okay. So you hear that people who are buying properties, when you want to make sure you have a good accountant or finance advisor that understands, accounting, bookkeeping, and that understands finance. So that goodwill is very important. That's interesting. And you can leverage that goodwill and use that as part of your balance sheet equity.
Yeah, so if you were refinancing debt and you need that 10% tangible net worth.
You can get it from goodwill.
Yeah.
That is very interesting.
And you still got to be fully collateralized. So
right.
You may not.
Yeah, but I mean, it's it's another tool in the arsenal,
it
correct?
Is. Mm-hmm.
So now I made some notes of things. We talked about timing. We talked about the tangible net worth. What in general, we said that you can, in terms of equity, you can, if everything lined up properly, you could be as low as 10% equity. What's typical in terms of the equity contribution someone needs to make?
I mean, the other side is that if it's a startup, then you're going to be more like 25%.
Okay.
So these are all existing that you're going to get down to 10%.
Okay. So if you're doing a new hotel.
Yeah, a new one, they need actually 25% of the total project cost into it and that 20% balance sheet equity.
Okay.
So it's just the existing ones, especially if you're refinancing debt. Which is what I see a lot. You could refinance an SBA loan with the USDA loan.
Oh, wow.
For somebody that has used up all their SBA eligibility, and that's the only type of loan they can get to do another hotel, another gas station, whatever business it is, then we can go in and refinance that property with the USDA, free their SBA up, and let them have that to do the new project.
Oh, okay. Well, that's very good. Now, we talked about the various property types that you guys do, the gas stations, just small business in general.
Right.
Everything you do has commercial real estate.
It does,
with
yes.
it. What about the person? What does that individual need to do in general to qualify for a USDA-backed loan?
Well, it comes back to the personal credit. I mean, I typically would like to see a personal credit score over 700.
Okay.
But we will go as low as 650.
Oh, okay.
And then as far as, it's great if they have some liquidity, so that everything that they put into this project, once they buy it, if they're buying a hotel or a gas station or whatever, that they still have liquidity left over.
Okay. So how much liquidity? What is the general rule of thumb in terms of when we say liquidity, what we're talking about, not actual water or something liquid. We're talking about cash. How much cash do you have left over after you make your down payment on that acquisition? The amount of cash you have left over, we call that liquidity or cash equivalents. And that's correct. So those stocks and bonds, that's part of the liquidity, correct?
Correct.
Okay.
And one thing I bring up is that there's no right or wrong answer to that. That's why giving somebody a loan is subjective to how we look at it. And if you're giving somebody $5 million to purchase a hotel, and when we do the transaction, they have $5 left, we're probably not going to think that's good, right? And maybe we would like to see that they have $100,000 left over, just because you don't know what you're going to get into once you buy a property. What could
you might have
down the
something
road.
like COVID. Right?
Yeah, you might have COVID hit, or you might need a new roof that we didn't realize, or something like that. So we do want them to have something left over.
Okay. Wow. Very good. So we kind of hit all the topics. We talked about what needs to happen for the borrower to qualify, how the property qualifies, how the location qualifies. And then we have really revealed something that is rarely revealed on the show, right? A person with 100% track record of getting deals approved when they submit it.
Well, it's lucky when you do a USDA loan. So.
Right. Well, it also helps if they deal with a all-star and not just a star, right?
Oh, I appreciate it, Charles.
Anybody can be a star, but Jana is the all-star, right?
You're so sweet. Yeah, and I forgot to mention the fact that my bank's name, which is Liquidity Financial, which is part of Citizens Bank, that means everybody. It's such a weird name, right?
Right.
When you say it, it just doesn't roll off the tongue very well, but people don't forget it.
Right.
But what it means is that.
Unless you're me, but go ahead.
Yeah. But what it means is with the stock market going up, that's actually when you look at that line going up like this, that's Liquidity.
I just learned something.
So that's who we are. My bank is Liquidity. We're going up and up and up.
Thank you so much for being on our show.
Thank you.
You have given us a great education about USDA financing, and we would love to have you back whenever there are changes in the program, or you just want to come back and hang out with us and talk to our audience, give them some new information. We would love to have you back here on our show.
Thank you, Charles.
All right. Well, fantastic. Don't forget to like this program. Don't forget to subscribe. But thank you for being part of the Capital Playbook.